Thank you, Chairman, and good afternoon to all of you. As the Chairman said, last year for the continental European stock markets was actually quite a flat year, no progress. I'm sure, as many of you will know, 2015 has got off to a much better start. Markets are up a fair amount. Now, we've obviously had some dark times in Europe, and it has felt at times as if we're very much in a tunnel. I guess the question is, with markets improving, is there now light at the end of the tunnel for Europe, or is it actually a speeding train coming? So over the next 20 to 25 minutes or so, I really wanted to cover this question about the outlook for continental Europe. Is there light at the end of the tunnel? Then there'll be a familiar section, familiar to those of you who've attended this presentation in the last 2 to 3 years or so, focusing on why I focus, in terms of my investment style, on dividend growth, and why I think this focus will continue to be successful going forward. And then finally, we will review the performance and the prospects for your company, the Fidelity European Values, especially in light of the changes that the Chairman mentioned that we made, very much thanks to your support at the end of last year. Now, you'll remember this quote from last year, and I have no shame on leaning on Sir John Templeton again this year, because I think it's very important to point out that the stock market cycle and the economic cycle are not necessarily one and the same thing. I'll give you a chance again to read it. Now, this bull market began probably 6 years or so ago when we were in the depths of the global financial crisis. And it's amazing to think that since then, the US stock market has actually more than trebled in dollar terms, while the European stock market has gone up around 2.5 times in dollar terms. Now, certainly we were all very pessimistic at that time, but actually it proved a good time to be investing. And I think it's also fair to say that there was a lot of skepticism around about the prospects for Europe 3 years or so ago, before Mario Draghi said he would do whatever it took to keep the Eurozone together. And clearly we've seen a good increase in stock prices since that time as well. I think generally people are more optimistic about the outlook for Europe now, but I'll leave it to you to decide whether we've got to the stage of euphoria. I think one thing, though, that has changed since I presented to you last year is investors' attitude towards Europe as a region to invest. And as you can see from this chart, which is really reproduces the Merrill Lynch Fund Manager Survey, which is probably the best known survey, which shows, which is the red line, that asset allocators are now allocating more to Europe and are actually underweight the US, having been overweight the US for a long period of time. And you can see that the allocation to Europe is as high as it's been really for the last 15 years or so. Now, generally in the investment business, we always say that you shouldn't be a dedicated follower of fashion. And Europe clearly is in fashion. But I would just highlight that actually the US market has been a good performer as a region over the last 3 or 4 years. So maybe following fashion in this respect is not such a bad idea. The key question, though, is why is Europe in fashion today? Why are investors excited about the outlook for Europe? Well, I'm sure you are all very aware of this already and have probably read in the newspapers the 3 sort of key short-term tailwinds that are making investors more optimistic about the outlook for Europe. We had the weakness of the euro. I mean, obviously, a lot of European companies report in euros, so this is beneficial just from the point of the unit of measurement. that their earnings are rising as a result. But also it's important for exporters and the competitiveness of Europe. Clearly, we've started off with QE, and so we're seeing, I think you can debate to what extent this is helpful for the economy of Europe, but certainly it's been helpful in terms of asset prices in Europe to date. And finally, and importantly, input prices have come down, the oil price has come down. And obviously, unlike the US, where there's a very big oil industry, in Europe, that's less of an issue, but consumers are feeling the benefit in their pocket and are spending more. And I think we saw that in some of the GDP figures released yesterday. So we certainly have some shorter-term tailwinds in Europe. Now, before we get too exuberant, I should remind you that only one of these three is here to stay, at least until September 2016, and that's QE. The other two tailwinds could reverse as quickly as they arrived. The euro could strengthen and oil prices could rise. I think it's also important to remember that Europe faces some very important long-term structural headwinds to growth. What are some of those headwinds? Well, the level of government debt. Certainly deficits have improved in Europe, but the general level of government debt remains extremely high in most countries. Secondly, demographics. We don't see a lot of population growth in Europe, and in addition to that, the population is aging. So increasingly, more pensioners are having to be looked after by a smaller working age population, the dependency ratio that you may have read about. And finally, and very importantly, Europe has often suffered from low productivity. And there was a great hope, and there's still a hope, that we would see a lot of structural reform in Europe to improve the productivity of European economies. And we have made some baby steps in that direction. Some of you may have seen the Loi Macron in France, which I think now allows you to have an Italian registered ski instructor when you go skiing in France, and not requiring you to have a French ski instructor. And one or two stores are now going to be open on Sundays. But generally, progress on structural reform has been slow in Europe. And I'm a little bit concerned that with some of these shorter-term tailwinds, the focus on structural reform will go away and we'll be a little bit complacent. I think that could be a problem for Europe because it will still be vulnerable to global economic growth and a slowdown in global economic growth. So I think we are seeing better times in Europe. That is good news. But I think it's important to remember that it is still likely to be a low growth era for Europe. And that's extremely important when I come on to discussing the merits of focusing on dividend growth. Now, as I mentioned before, the stock market cycle and the economic cycle are two different things. And the stock market cycle has a habit, the stock markets have a habit of looking forwards and anticipating changes in the economy. And that's certainly been the case in the European stock markets of late. So the big question here is whether this better news is already discounted in share prices. And I think this chart is rather alarming. As you can see, we're now approaching levels in terms of valuation above what we saw before the global financial crisis. Not quite as high as we saw during the tech bubble, but certainly getting up there. And of course, you will hear from a lot of fund management companies, probably, and other fund managers, that this time it's different. Not to worry. Again, leaning on our friend John Templeton, as he says, this time it's different, the four most dangerous words in investing. But why will people tell you it's different this time? Well, a lot of people will talk about bond yields being particularly low, that therefore equities look attractive relatively. That may well be true, but it's a relative argument. And of course, bonds can fall as well as rise, as we've seen very recently. In addition to that, people will say, well, don't worry about this because earnings will grow much faster than people expect, and that will bring the PE ratio down. And I have some sympathy for that. I think the rate of earnings growth, certainly in euro terms, is beginning to pick up in Europe. But I think given where we are in the stage of the global economic cycle, I think it's unlikely that that will be the solution to high PEs. Finally, and perhaps most importantly, just because the market's expensive doesn't mean to say it can't continue to go up. I always remember, I think it was in 1996, when Alan Greenspan famously said that he thought that the US market was showing signs of irrational exuberance. I think I'm right in saying that since that point in time, in 96, the US market actually went on to double. I was very interested to see just the other day Yellen saying that she thought that equity prices were a little bit high. So maybe her timing will be as off as Greenspan's was. But I think that's a slightly, we're into dangerous territory on valuation. And it's, I always think that one has to be a little bit cautious, even if markets can continue to rise. And clearly, in Europe, given QE, given all the liquidity we have, that is a possible scenario. So is it light at the end of the tunnel, or is it a speeding train coming? At the end of the day, bull markets don't die of old age. Something has to go wrong. And I think there are a lot of things going on that we can worry about as investors. Clearly, we've got interest rate rises likely in the US. I think they'll be more back-end loaded than front-end loaded, but that is a concern for investors. Emerging markets. A lot of investors are concerned about China slowing down. Maybe that could get out of control. We should probably also mention Greece, which I'm afraid now is classified as an emerging market. And I'm sure we'll come on to the problems in Greece in questions, but there's certainly potential for that to upset the apple cart. And geopolitics. Russia, Ukraine has gone a little bit quiet recently, but there's clearly potentials for problems there. And in addition to that, what's going on in the Middle East, ISIL, etc. So there's a lot to worry about, but I think it's quite hard to point to a specific catalyst at this point in time, a bit like, say, the US subprime collapse before the global financial crisis. So that's really all I wanted to say about the outlook for continental Europe at this point in time. Hopefully you've picked up that I'm somewhat cautious about the outlook. But I think the main point that I want to make in terms of the outlook is that I do think, although we're seeing better times, it will continue to be a low growth era in Europe for the reasons, the structural reasons that I mentioned. And that's very important to remember when we come on to discuss my particular focus on dividend growth in terms of my investment style. So again, this is a quote that you'll be familiar with from my past presentations. I think I've included it not just last year, but in every presentation I've made to you over the last 5 years now. But that's because I think it's an extremely good one, and I think it really describes what we do at Fidelity, which is that we don't try to time markets. We take the view, and I take the view, that you have given me the money to invest in continental Europe. You can always sell the fund if you don't like the prospects. And I will always stay fully invested because I fully recognize that despite my personal caution, very often, if you're not invested, you can miss some of the biggest up days after the big down days, and we've done a lot of research on that at Fidelity over the years. So your company remains fully invested. In fact, we have a little bit of gearing in the fund. It's currently running at about 3%. But what's important is looking at the companies in which I'm invested. I'll make a couple of general comments here that actually companies in Europe currently only is sourcing about 50% of their sales and earnings from the European economy. So it's important to remember that when you're thinking about the prospects for the European economy relative to the global economy. And as I've shown you in many previous presentations, what drives stock prices is not necessarily correlated to what's going on in the economy. In fact, many academics have demonstrated that the correlation between economic prospects or economic growth and stock prices is very small. It's really profits and dividends that drive stock prices. So what is happening to the companies in which you're invested? Well, I'm very focused on companies that can grow their dividends. And the fund is invested in attractively valued stocks where I think we can see good, consistent dividend growth on a 3 to 5 year view. Why do I focus on companies that can grow their dividends? Well, that's really captured in the right-hand slide on this chart. And again, in previous years, I've shown you that generally companies that grow their dividends consistently outperform the stock market. Now, of course, the problem with this is backward-looking. We've selected the companies that successfully grew their dividends over the last 3 years. And looking forwards, it's much more difficult to identify which companies will grow their dividends over the next 3 to 5 years. And you can be pretty sure that the past is not a reliable guide to the future. So how do I go about identifying attractive dividend growers? Well, I have 4 key criteria that I use in selecting companies for the portfolio. And the first 3 really relate to the ability of a company to grow its dividend going forwards. Positive fundamentals. Typically, I like companies that are already proven business models, not companies that might make a profit at some stage in the future, be they biotech or EMP, but companies that have a proven track record of sales, earnings, cash flows, and dividend growth. Secondly, I do like companies that are cash generative. Clearly, companies can borrow to pay dividends, but I found over time that it's companies that have a good track record in terms of cash generation that tend to have a good track record also in terms of dividend growth. Finally, I prefer companies that have a strong balance sheet. You might argue that given the cost of borrowing these days, companies should be much more levered. But generally, I found actually that companies that have a strong balance sheet have a competitive advantage through the cycle because they are able to continue to invest in their businesses and do M&A when times are hard, which is usually the right time to do M&A. And finally, and very importantly, and that's why the "and" is so big on this chart, valuation. This is not dividend growth at any price. It's dividend growth at a reasonable price. So I'm always looking for a good trade-off between the rate of dividend growth and the dividend yield that I get on the stock. Now, as I mentioned to you, I do believe that we'll continue to be in a low growth era. I think this strategy, it's certainly been successful during my 20-year career, but I think it's particularly successful in a low growth era because I think companies that can demonstrate growth when the economic growth is low will continue to be highly valued. Now relax. I'm not going to tell you about Novo Nordisk again this year. This is the slide from last year. And you may remember that Novo Nordisk had a slightly troubled 2013 for various reasons, most notably because one of its key pipeline drugs, Tresiba, a long-acting insulin, was required to do further safety trials in the States. I'm glad to say that Novo Nordisk has actually resumed, or rather returned to form since the last AGM and has had some very good performance. And most recently, that outperformance has accelerated because Tresiba looks like it has passed some interim trials and looks like it will be coming to the US market potentially by the end of this year. Novo Nordisk is the sort of stock you'd expect to be in the portfolio given the criteria that I invest. But it might surprise you to actually know that my largest positive or active position currently in the portfolio is in fact an Italian bank. I mean, Italy probably has been a rather ugly landscape in the last 3 years. But at Fidelity, we have our research department, which is very extensive, has full coverage of the market. And we keep turning the stones and keep looking for good opportunities to invest, even in difficult landscapes or difficult environments. And as I mentioned, as things generally are improving a little bit in terms of the economy in Europe and also in Italy, that is throwing up some good opportunities. And Intesa Sanpaolo, as the leading retail bank in Italy, I think is an excellent opportunity. And it very much fits my model in terms of dividend yield and dividend growth. There was actually a management change at Intesa Sanpaolo about 18 months or so ago. And the new management team have come in with a very detailed business plan to improve returns. Clearly, they will also benefit from an improvement in the economy and a reduction in loan loss provisions. And in addition to that, very importantly, the industry structure in Italy is about to change. There has been some legislation change such that the Popolari banks, which are a bit like, say, our old mutuals, where basically somebody who owns one share has the same vote as somebody who owns 10% of the company, this has to change. They have to become joint stockholding companies. And we believe that this will result in a wave of consolidation amongst the Popolari banks in Italy. Generally, these Popolari banks, over time, have been run really for the benefit of customers rather than shareholders. And I'm not saying that's necessarily a bad thing, but that has been the case. And as a result, generally, the pricing of loans has been low. We believe that that will change with this industry structure change, and that the Italian banking system, which has previously been not very profitable, will become more profitable following this consolidation. So Intesa Sanpaolo, does it tick the boxes? Yes. On positive fundamentals, it does. Strong balance sheet? Yes. Relative to the other Italian banks, it has a very strong balance sheet, and also relative to other European banks, Core Tier 1 ratio of 13%, a strong leverage ratio of 5.7%. Some of you will remember the Deutsche Bank announcement recently about how they're trying to get to a leverage ratio of 5%, I think, by 2020. Intesa is already there. It is a very capital generative business. It is making profits. Despite growing dividends, it will continue to be capital generative during the period of its plan out to 2017. But perhaps most interestingly, the key output of this plan and of their targets are dividends. And they plan to grow the dividends really quite attractively from the current level, such that we think the dividend yield for this year will be actually more like 4%, because the stock has moved up a little bit since we prepared this slide, about 7% in 2016 and about 9% in 2017. So if, as we expect, they hit this plan, it will be an extremely attractive stock, both from the point of view of yield and also from the point of view of dividend growth. Now, finally, I wanted to move on to the performance of the fund and the prospects for the fund, given the changes that the chairman mentioned. So first, a big thank you from me to you for supporting the changes that we put in place. And what are those changes? Well, as you will remember, the amount that we were able to invest in UK listed names was restricted to less than 5% of the portfolio. That will no longer be the case. And in theory, the investment in UK-listed names could go up to as much as 20%. It's very unlikely to do that. But the reason that I was keen to make this change, well, we already have some investments in the portfolio in UK-listed names. And 3i, for instance, the majority of its investments is actually in companies which are headquartered in continental Europe. Intertek competes with two very important European companies, SGS and Bureau Veritas. But our analyst, who covers all three companies, prefers Intertek as an opportunity. So it's very important to remember that the research department at Fidelity is organized on a pan-European basis. So we have the same analysts covering continental European companies as covering their UK peers within sectors. And very often they will come to me and they'll say, Sam, you own this company, it's listed in Europe, very similar to this company that's listed in the UK, both in terms of where it does its business, but also in terms of the nature of its business. But I think, as an analyst, the UK opportunity is that much greater. I think it's important for me to be able to follow that advice and use that flexibility to buy that company. Now, it's very important to remember that, we're not trying to change this fund into a pan-European fund. The spirit of the fund is that it will still very much be focused on continental Europe and on companies that are doing business in continental Europe. Secondly, we've asked for a broader use of derivatives. And we actually, the main reason that I was interested in this was the ability to go short certain names in the European marketplace. And it's important to understand how we'll do this. So when I'm shorting names, in a sense, I'll do the opposite to what I'm doing on the long side. So I'll be looking for companies that I think either don't pay dividends, or where I think the dividend is unsustainable, where I think the valuation is unattractive, companies where they don't have a good track record in terms of cash generation, and also companies where I think the balance sheet is weak. We did put in place already our first short in January of this year, and we added to it subsequently. And for that reason, we have very strict disclosure requirements at Fidelity. I'm not able to tell you the name of the company that we are short, but we have already started this strategy. And in both cases, in terms of the freedom to invest more in UK-listed names and also in terms of use of derivatives, I'll be extremely careful in terms of adding names, as careful as I am in terms of investing on the long side. So many of you may find my progress in this respect to be frustratingly slow, but I make no apologies for that. I think it's extremely important on the shorting side to be as careful, if not more careful, because obviously you can lose more of the money that you invest on the shorting side as opposed to on the long side. So the company's objective, we've added principally, but generally in terms of the spirit, it has not changed. This fund is all about achieving long-term capital growth from the stock markets of continental Europe. So as we say, the new powers will enhance and protect the portfolio. They will not make it totally different. So what has happened in terms of performance year to date? Well, as you can see, the European stock markets have been strong. And I'm glad to say, very much with the help of the Fidelity research effort, broadly speaking, we've tracked the progress of the market. In fact, I think year to date, we're a little bit ahead of the market level. I think QE generally has lifted all boats and has not been particularly discriminatory. So with the weakness in the euro, exporters have done well. Domestic stocks have done well on the assumption that domestic economies will improve, etc. So I think it's important to put this performance in a longer term context. It's important to remember that generally I'm running this fund very much with a mainstream approach, with the objective of trying to outperform the benchmark over time by a little bit, such that over a longer period of time, the blue line and the red line diverge. And you can see, although we've had some good periods, we've had some less good periods, generally that's been the case. If you look at the right-hand chart, you'll see that since I took over the fund, the index has returned a very satisfactory 8% per annum. In terms of NAV, that has risen around 11% per annum, so about a 3% outperformance of the benchmark. And the share price, largely as a result of the narrowing of the discount that the chairman mentioned, has gone up around 14% per annum. So really, to summarize, I think we are seeing better times in Europe. For that, I'm very grateful. But I do strongly believe that it will continue to be a low growth era in Europe. So I think focusing on companies that can continue to grow their dividends in this low growth era will continue to be a successful strategy. And I'm very grateful that you've given me more tools to continue the long-term outperformance of the fund relative to the benchmark. Thank you.